Welcome back, friends. So we have the US consumer inflation spiking once again, and this is roiling the US markets. The University of Michigan Consumer Survey has shown that the respondents expect inflation a year from now to be 4.3%, a full 1 percentage point jump from January, and the highest since November 2023. Now, worries over inflation dovetailed with lower optimism overall as the headline index has fallen to 67.8, a 1 month drop to 4.6%, and an 11.8% move lower from the same month a year ago. Consumers have grown dramatically more worried about near-term inflation as President Donald Trump pushes aggressive tariffs against major US trading partners. Namely, we have the Canada, China, and of course, Mexico. All this is causing quite a lot of concern amongst consumers that the inflation will not be at the levels that they are today. The University of Michigan Consumer Survey for February has therefore reignited inflation fears. Although Donald Trump has postponed tariffs against Canada and Mexico, the looming threat of price pass-throughs to the consumers has shaken sentiment, and the University of Michigan Consumer Survey is indicating just that. China has in fact levied retaliatory tariffs following Trump's move. That the consumers appear to be worried that high inflation will return shortly again this year. This is only the fifth time in 14 years that we have seen such a large 1 month rise of a full 1 percentage point or 100 basis points in the year ahead inflation expectations. That's not a very good scenario as far as consumer sentiment and inflation expectations are concerned. Longer run expectations, however, weren't hit as much, with the 5-year outlook drifting up to 3.3%, as just a 0.1 percentage point gain or 10 basis points. Stocks have turned lower after the report, and the Dow Jones Industrial Average is now down over 200 points, and Nasdaq down over 250 points. Friends, this is a scenario. Higher inflation means that the U.S. Federal Reserve will be more concerned and will not be able to reduce interest rates as quickly as people have been anticipating on Wall Street. Therefore, with higher inflation, firstly, there is the commander-in-chief asking for lower interest rates, but this therefore raises the mortgage interest rates. The inflation increases further, dollar becomes stronger, our emerging market currencies begin to get weaker, but they become export more competitive. So you see more exports coming in from countries whose currencies are depreciating, which may therefore turn out to be a mixed blessing for them. It's a little more difficult for countries such as the United States with strong currencies. Their products become less competitive in the world scenario. To get to know where the markets are headed from here, we have rightly predicted a few days back that a jobs report along with the University of Michigan Consumer Survey will cause markets to go down over the next few days, and we have seen that today. Friends, get to know where the US markets are headed over the next few days, weeks, and months, please do join our Prime or Prime Plus Telegram groups, which are addressed specifically over the outlook for US stock markets. You can do that by WhatsApping us on 9820861044. Alternatively, you can also email us at globalmoneyininvestor@gmail.com. Happy investing and have a great investing day. Take care. Bye-bye.